Hey y'all, it's your girl Prenicia and I'm back with another YouTube video. Today's gonna be we're gonna touch a little bit on liquidity today, y'all. Now listen, I'm not an expert with liquidity. It's probably only been like, a month, maybe almost two, maybe almost just now a full month of me using liquidity with supply and demand to enter my trades or just to even find trades. Now, I definitely think that this is very important for me to explain because how heavily I rely on this when charting and finding trends and all that. So when I first get on the charts, the first thing that I'm looking for is liquidity. Liquidity helps me figure out where the charts is trying to go before it makes the move in the direction that it actually wants to go, before it makes its real move. So in this video, I'm going to show you exactly how I mark up liquidity on my charts and how I use it to help me find my trades. Now let me just explain what exactly liquidity is. And I'm gonna keep it real simple because it took me a whole day of YouTube videos for however long, hours, for me to get a grasp on what liquidity even was. And it even took me to go type it into ChatGPT and have ChatGPT break it down to me so that I can really know what it is that I'm looking for. I see it while it's live on the charts and be able to explain it and know what I'm doing so that I can keep doing it. Liquidity is basically where a lot of orders are sitting on the market. This is usually where most traders have their stop losses or their pending orders. And because there are so many orders there, price tends to move towards that area to collect liquidity before moving the real direction that it wants to go. Now, I'm going to show you guys some examples of some common liquidity areas. So for the most part, some common liquidity areas are previous highs, previous lows, equalize, and higher highs and lower lows. Now, I might be using either or gold or NAS for these examples, but I just want to be able to give you guys good examples from both because, I trade both, but mainly I've been spanking gold lately. I'm not going to lie. So I'm going to give you guys an example of each of these common liquidity areas. So we're going to look for previous highs. So previous highs, if this part of the charts weren't here right now, this would be our most previous high. And it has liquidity lying there because buyers bought into the market and then sellers sold into the market. So we have a higher high right here, which means we have liquidity lying right there. Now, previous lows. Without seeing all of this on the chart right here, our most previous low is going to be right here because we have a red candle, sellers were selling, and then green candle, buyers were buying. Meaning we have liquidity right there. We have some stop losses right there, and we have some more pending orders right there. That's previous lows. Now, equal lows, let's see if I can find equal lows. Hold on. Now, this isn't completely equal right here, but it's close enough, so we're just going to use it. So this low right here and this low right here. Typically, equal lows are like literally like same price almost for real. However, I'm not going to try to find one because sometimes it could be time consuming. So pretend that one of these candles is down here touching this line as well. That's an equal low. Oh, boom, right here. Okay, I have an example of an equal low. This is an equal low right here. This candlestick, same price point as this candlestick. We got some liquidity sitting right there. We got stop losses right there because some buyers got into the market and, just thought it was going to continue going up. So their stop is going to be right there. And then we got some sellers that were thinking that it was going to continue going down. So now their stop loss is up here where this most recent high is at. So at some point, the market is going to come up here and take out this liquidity as well. But anyways, that's an example of an equal low. It's not identical, but it's close enough. And then an example of equal highs is going to be right here. And again, this isn't the best example because they're not literally the same price point, but they're close enough. And this is just to give you an idea of what equal lows and equal highs look like. It's just literally when the candlesticks are at the same price point. And so just know that liquidity is lying there because at that point where that price point is, there was a couple of times where it came down. The sellers tried to get in. They tried to push it down further, but then the buyers got in and they rejected that and pushed it up. So then there's stop losses right there. And then it's also going to be taking some sellers out when it does continue to go up and take out the other side of liquidity. Hopefully that made sense. And then when it comes to higher highs and lower lows, green stick or red stick, green stick, lower low. There's liquidity sitting right there. Green stick, red stick, higher, high. There's liquidity sitting right there. Let's go on the 4 hour. Yes, there's liquidity down here as well, but it was already taken. So we're just going to look right here. Oh, boom. We got kind of equal lows. Equal highs, just a little bit. But we do have liquidity sitting right there for sure. We have liquidity sitting right here. It's a higher high, right? And then we got a green candle and we got a red candle. Buyers bought right here, sellers sold right here. So we got stop losses up here and stop losses down here. But this came up and it wasn't able to break that price point, so that created even more liquidity. Buyers bought and got in, but they wasn't able to get in enough to make a new high. And then sellers got in and sold. And so again, we have stop losses and we have pending orders that are getting placed around these areas, which make it a liquidity area. Okay, let's move on. Now, I'm going to explain a little bit on how I do my chart analysis, including liquidity. Now, when I do start my chart analysis, I don't immediately jump into my entry time frame. I start at the daily and then I work my way down. I use my higher time frames to give me a better idea of where the lower time frames might be going for the day. So like I said, I usually start at the daily and then I move down to the 4 hour, and that's where I start to kind of mark up where some liquidity might be lying to see where price is probably going to go before it goes where it actually wants to go, especially depending on what it's currently doing. I'm going down from the daily to the 4 hour to see the bigger picture of what's happening and where price might be going. Now, how I use my higher time frames to find liquidity, like I said, on the 4 hour is where I start to mark up some liquidity. So on that 4 hour is usually where I'm marking up higher highs and lower lows to see where price might be targeting. Those areas often hold liquidity because those are where a lot of traders put their stop orders at. So sometimes price will move to grab that liquidity before it goes the direction we actually want to trade. Now, along with my 4 hour time frame, I do also mark up key liquidity levels on my 1 hour as well. I just find that the 4 hour and the 1 hour liquidity is where its price tends to react heavily off of, and also the daily. But if the daily is just like ranging and the 4 hour, 1 hour is really moving and it hits a liquidity spot, I'm definitely looking to see if it's going to react off of that for sure. And I want to be able to see that on my lower time frame with the 5 minutes. So that's why I mark up those lines and then go all the way down to my lower time frames to see if, one, it already reacted off of that liquidity, which 9 times out of 10 it didn't when you're marking it on the 4 hour and the 1 hour. Because if you're marking it up, it's because it is untapped liquidity. It's liquidity that has not been swept yet. So by the time you get down to the lower time frame, you'll see that it's either heading that way, and that's most likely where it's targeting, or it's going the opposite way or something, because you're marking up higher highs and you're marking up lower lows. So you're seeing which way it's heading right now to take out liquidity in order for it to go the actual way that it wants to go. Now, how I combine my liquidity with my zone, supply and demand. Don't worry, y'all. I still use supply and demand. I just added an extra thing to it. So once I see where liquidity is, the next thing I'm looking for is a zone that price might just react off of. And this could be either or, a supply or a demand zone. But obviously, that's depending on which side of liquidity we just took, sell side or buy side. That'll tell us what type of zones we even want to be looking for a reaction off of. If price takes liquidity and then taps a zone, that's why I start looking for trading opportunities. The candlesticks just tapping a zone is cool and all. Like regular supply and demand is cool and all, but taking liquidity and then tapping a zone, that's a whole nother type of trade right there. As you may know, my main time frame that I trade on is the 5 minute. That's really the only time frame that I trade on. But if I can't find a clear good zone on my 5 minute, I do look at my 15, 30 and hour just to see if there is any zone that it is reacting off of. Now, speaking of higher time frames and zones, when I'm going down the chart analysis or when I'm going down the higher time frames, I'm looking for higher time frames demands and I'm looking for higher time frame supplies. And no, it's not because I want to take a trade off of these. If I'm already have an idea of where the trade is going and a demand is supporting it on the higher time frame, cool. But if I'm thinking that the charts is about to go down and I see a demand right there, I'm marking that demand up because on the lower time frame, if I'm taking a sale and I know that it's going to be a short-term sale, I want to know when I need to get out the charts. When is danger zone? Now, the chart can flip whenever it wants. It can flip before it even gets to that zone. But if for whatever reason it's not flipping and it's still going down, and I know that right now there isn't no support or resistance or whatever, but there may be some support or resistance to a supply or a demand zone coming up soon, I want to know to get out that trade or to not even enter if we're too close to that zone. So that's another way how I use higher time frame zones to kind of help with my entries, stop losses, and just trades that I'm going to take in general. And also just to give me more confirmation on my trades, because like I said, if I'm thinking that we're going up and that's my whole idea that we're going up and we just swept sell side liquidity, tap the demand zone, but we also tap the demand zone on the 15 minute, 30 minute, and an hour. Oh yeah, I'm in that trade because what? And again, when it comes to me marking up my 4-hour and 1-hour liquidity, higher highs and lower lows, and then me marking up my higher time frame demands and supplies when I can't find my zone on my 5-minute, it's because sometimes a higher time frame zone or higher high or lower low or liquidity area is where the market is actually reacting off of. What happens if there is no zone? And the reason why I even mention this is because I also look at my highs and lows of different sessions. Because we know that the charts love to manipulate, I look at what my London highs and London lows are and what Asian high and what Asian lows are. Because one thing I've learned is that each session likes to take out liquidity from each side of each section, if that makes sense. I'd have to do probably your own video on that in itself, but like, say the Asian market is moving down, the London market is gonna take out sell side liquidity and then go up. And then pre-market is gonna take out upside liquidity and then go down. And then New York Open, it has a bit of manipulation, of course, but New York Open is what the chart actually wants to do. Now, some people may disagree with that, but that's just what I've been seeing on the charts lately, and it's been working out for me. So I'm very well aware that sometimes price might be going to take out a different sessions high or a different sessions low, and there may not be no zone underneath that, or just in general is going to take out some liquidity and there may not be no zone after that. That's totally fine. We wait for it to make a zone. When the chart is coming down or up to take out that liquidity, it's usually the beginning of the trend change and or maybe just the beginning of that leg that you're looking for, that bullish leg or that bearish leg that you're looking for. So there's always going to be a way to get back in, whether you're getting in on the reaction of a zone or the continuation of a zone. And I'm gonna do a whole video on that as well, because that's something that I've been learning as well. If you've been watching my Instagram stories, you know. So that's gonna be its own video. When it comes to liquidity, supply, and demand, there is a way to miss out on the trade. Do not get me wrong. There's very much ways to miss out on the trade, but there's always going to be a pullback. The market moves in waves. So at some point, at some time, there is a way to get in the market. The market moves in waves. It's going up and down. And then when it reacts off of that liquidity sweep and it has a displacement and this large big candle, it creates a supply or demand zone. It's coming back to tap that zone. You can get in off that. You can get in off the reaction of a sweeping liquidity. Like there's ways to get in and not miss a trade if there isn't a zone already under that liquidity. So if there isn't a zone underneath where liquidity just swept, wait for the displacement. A strong price move. So if you're looking for demands, it just came down, swept out the liquidity below, and now you're waiting for it to react off of that liquidity sweep. Is going to make a big old candle push up, strong candle, body, less wick, body. I'm talking body, yaddy. And that is a displacement candle. Same thing, vice versa. It goes up, it takes out the liquidity up there, has a strong move down. That is a displacement candle. That is letting you know that, okay, Buyers have officially took over. Okay, sellers have officially took over. So once it does that, and also a displacement candle has to break some type of market something, whether that's 1 candle, 2 candle, 3 candle, it needs to break something in order for it to really be a displacement. So once that displacement happens, it's telling you that, hey, we're in the market now, whichever side of the market that you're on for. So then after that displacement forms, then you wait for a pullback back to that zone that was just formed. So like I said, if you have no zone underneath your liquidity, just wait for one to be formed. Now, how liquidity helps me find the direction. I feel like I've said this a lot in the video, but I just have to emphasize that liquidity is what's helping me understand where price is trying to go. When I say I'm able to like look at the charts now and kind of read it like a book, like I'm really learning its characteristics, especially on gold, which is crazy because gold used to spank me. So I've been learning gold, or I've been learning just the charts in general and just their stories, and knowing about liquidity helps so much. For example, if there's liquidity sitting above a price, the market might push up to take that liquidity first. After that happens, price might react from a zone and push the opposite direction. Now listen, I am still learning liquidity, supply and demand myself, so hey, bear with me. So this isn't like a full detailed video of the entire concept. This is just how I personally use liquidity to help me guide my trades. So I hope this video was helpful for y'all. In my next video, I'm going to be explaining how I enter trades once price reacts off of my zone. And in that video, we'll talk about the reaction trades compared to the continuation trades and how I decide which one I want to take. I hope y'all really enjoyed this video. I hope it was helpful and it kind of just gave you an insight of liquidity and kind of just helps you read the chart a little better and understand why some of your zones might be getting taken out, and that's because liquidity is lying right there. I think one key thing I forgot to mention in this video, but will be coming in the next video with supply and demand, is that with liquidity, supply and demand, you're kind of expecting it to disrespect your most recent zone in order to take some liquidity and tap a untapped zone. I'll go more into that in the next video, but it's a bit different from just regular supply and demand, so I just want you guys to know that. And it has a little bit of different rules as well, but I'm loving it here so far. It's been helping me read the charts better, know the characteristics of what I'm trading and where the charts might be going for the day. And it's been helping me out a lot. I really love it, so I can't wait to teach you guys more on liquidity, and the more I learn, the more y'all learn, so don't worry, y'all. The videos are coming. I just want to make sure I actually know what I'm talking about before I spit it at y'all, okay? I hope y'all enjoyed this video. Make sure you like, comment, and subscribe to your girl. Let me know what questions y'all have about liquidity, what videos y'all want to see coming up, and y'all already know what's coming next. So we about to really lock down on liquidity, supply, demand. 2026 is our year. And again, no, this is not me completely just changing my strategy, because yes, I still use supply and demand. I just added something to it. So yes, again, I hope y'all enjoyed this video. Make sure y'all like, comment, and subscribe to your girl. And I hope y'all have a great day, a great rest of your trading week. And yeah, bye.